Welcome to the Estates Made Simple podcast with Jenna and Gordon Vanderleek. We are on a mission to simplify the world of estate administration, helping executors gain the knowledge required to manage an estate. Please note, the following is for informational purposes only and is not to be considered legal, tax, or financial advice. We recommend you seek individualized advice for your unique situation with qualified professionals.
Welcome to another episode of Estates Made Simple. We are here to provide education and support as you navigate the complexities of estate administration. And today we have a lovely topic about adjusted cost base. You may have heard that term ACB in dealing with different assets of the estate, and we wanted to dive a little bit deeper into how it may be calculated and the importance of an ACB. So we pulled up the definition of adjusted cost base on CRA's website for all our listeners. So the definition is the adjusted cost base is usually the cost of a property plus any expenses to acquire it, such as commissions and legal fees. The ACB also includes capital expenditures, such as the cost of additions and improvements to the property. You cannot add current expenses such as maintenance and repair costs to the cost base of a property. So all that's to say, there's a lot that goes into the ACB. And we're going to start our discussion on the ACB of real estate. That's probably most often where you'll deal with the ACB. So as an executor, you may have to go through the deceased affairs and determine what they purchased a property for and determine any costs that they incurred over the lifetime of that property that may add to the ACB. Many individuals do not keep record of such costs, so you're going to have to dig through and determine what should be included and do your best and try to put the pieces together.
And I think that's an important step because certainly one of the important tasks for the executor is to make sure they're properly filing their taxes. And at the end of the day, you don't want to pay more taxes than necessary. So another way to look at it would be this is relevant in the context of property that is other than one's principal residence. There's a capital gains exemption for that. And while you still may need to know what the cost base is, usually there's not the tax consequence. But if this is the family cottage or cabin property or recreational property or an investment property, rental property, anything other than the principal residence exemption, it becomes highly relevant. And when we're looking at why is this important? So making the calculation becomes really important. And we want to just recap in this episode a little bit of what we talked in prior episodes, which is how does this factor into the calculation? I guess just taking a step back, oftentimes this is a conversation between the executor and the accountant, which does point to, I think, information we've given on other episodes, which is get your accountant chosen and retained early on in the process, right? Because you don't want to do this the week before there's a deadline for filing the tax return. This, as this topic suggests, may be a bunch of work required ahead of time to gather the information that's necessary. So one of the things the accountant will have a conversation with you as the executor is there might be some capital gains. There's going to be some tax owing. Why is that? That is because immediately on death, there's this deemed disposition. So it's as if everything the person owned, you're deemed to have disposed of, even though it hasn't been disposed of, right? You go, it hasn't been sold yet. You haven't put the for sale sign in front of the rental property to try to sell it. But the laws, the Income Tax Act, the rule in Canada is you're deemed to have disposed of everything when you pass away. So now if you're looking at capital property, there's going to be capital gains tax. And so we're going to look at what the increase in the value is, assuming it's gone up in value from its current value, the fair market value as of the date of death, to the adjusted cost base. As the name suggests, it's the baseline, typically what you paid for the property, plus any additions, anything you've added to the cost. An example would be you put a new roof on, or you did an addition, or something which isn't a day-to-day expense for running the property. That's not eligible. But if you've improved the property, you've added to the property, from an accounting perspective, that's part of now the building, if you will. So you can add that to the original cost. So the capital gains is based on the difference between the cost base and the fair market value. And that is how you determine the gain on the property. That'll show up on that final tax return. And obviously, if you can't prove or you have improper information with regard to the cost base, maybe you're going to pay too much because you don't have the receipts, or you have to go find the receipts for the addition or for the new roof, for those capital improvements. It becomes really important to make sure we have good records on that. So a couple to summarize then, it's the tax calculation for capital gains, right? So if you have property which is subject to capital gains, you've got to do this calculation, difference between fair market value and the adjusted cost base. So that's point number one, because it affects capital gains. Interestingly, we're recording this in the time period where there's adjustments to the amount of inclusion for capital gains, and the taxation rates for capital gains are changing. So you definitely want to have the accountants involved and get their advice in this. But then the related, maybe second point would be, we want to make sure you have good records. So if you've agreed to be the executor, let's say mom and dad have approached you and you agree, yes, I'll be the executor, it would be good to say, do you have records of everything? Get those receipts and make sure the accountant has them in their files, or give them to me, because that's going to make a difference the amount of tax that we have to pay. You want to minimize tax, and obviously you're certifying anything you file with Canada Revenue Agency is accurate. So you have to make sure it's accurate, right? And you don't want to have audit risk. So that's the reason why this seemingly technical term, like why do I have to know about adjusted cost base? Because it makes a big difference to a check you might write out of the estate to Canada Revenue Agency, that we have to go through and make those calculations, or you're going to have somebody help you through that process. That's the importance of hiring an accountant, because that's not a do-it-yourself project, in my view. There's lots of complexities, and the rules are ever changing. So you want to make sure you record that correctly and you do those calculations correctly.
Absolutely. And I think another place executors may come across ACBs is when it comes to stocks that the deceased held. The deceased may have purchased and sold the same company stock over their lifetime, which does affect the ACB of the individual unit. And so that's going to be another calculation. And like you said, Gordon, it's important to bring the accountant into the discussion to make sure the calculation is done correctly. But on that note, best practice if you're doing your own will and estate plan is to keep track of all of this stuff. Keep it in a nice, neat place that your executor can easily find and record, so that you pay less tax overall.
Yeah, because if you have to prove all this stuff, you may only be able to go back so many years as far as banking records, or the contractor that helped with the renovation is out of business and you can't find those records. And did the person keep appropriate records? It's not something you would think you would normally keep track of, but would be important to do some analysis of what are the records you do need. And again, from a planning perspective, in advance of being in the role of the executor and having to come up with this information, is have a conversation with the person's accountant and say, do you have everything you need so that you can fill out the tax return very simply? Some time spent in advance would be time saved as part of your exercising your duties in the estate as the executor or the administrator, for sure. So with that, I think some good points to consider on what could be arguably a fairly technical or esoteric topic of calculating the adjusted cost base, but can make a real difference to the beneficiaries if they're not, to ensure they're getting the maximum value in the estate and discharging your responsibilities properly, and making sure that everything goes as smoothly as possible as part of the estate administration. Is to make sure that you have those records in place is obviously ideal, but also recognizing that if you don't and you need to spend some time to go find them, determining that early on in the estate administration process is good advice, rather than leaving it to the end when you're facing with a deadline. Because while you could always file an amended return, there's costs associated with that, and that's not ideal. So you definitely want to analyze what the records are that you need, where is this applicable, and have a good understanding of this topic and seek the advice of the accountant to help you through that process. So with that, thank you everyone for listening in on this episode. It's good as always to podcast together with you, Jenna. And so I want to thank our listeners for listening in and our viewers for viewing on our YouTube channel. Please subscribe so you don't miss any future episodes, and reach out to us if there's any questions you have about what we've talked about, or if you have ideas for future topics. With that, we'll wish you well, and we'll look forward to our next episode, our next recording, where we talk about all things state administration.